Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Okay, let's get in today's Q&A episode. Just a bit of an update. I'm recording this, this will be published in September. We're just getting into 10 July is the question I'm about to answer. So just to let people know that if you send in a question, we get about sort of 30 or so questions per month, sort of about 2 months behind. So if you submit a question, I'll get to it certainly, but there might be a little bit of a delay. But look, want to get through as many as possible, so keep them coming. And, if we get overwhelmed, I can always do a third episode in a week. I don't want to make that commitment, of course, but, I can always do that because I love answering the questions. And, that's always been one of my complaints many years ago with podcasting is it's sort of one directional. It's not rather than you never get sort of any feedback. And the questions, I enjoy it. I hope everyone enjoys listening to them and listening to the answers. And what Campbell and I try to do is try and give you a broad answer so that not only helps the listener who wrote in, but anyone else that might be in a similar position. Okay, let's get to Brett's question. Brett's the first question. Long-time listener of the show and love the content you release, by far my favourite financial podcaster. So thanks, Brett. That's awesome. I'm 35 years old and a relatively low income earner, $80,000 a year. I've been accumulating assets to build wealth with the goal of retiring at age 45 with around $100,000 to $120,000 a year of passive income. We live in regional New South Wales and live completely off the grid, so relatively low living expenses and no dependents. Current financial position is that I have a home, PPOR, which is worth 1.75, 5 investment properties with total value of 3.1 with about 1.5 mil of debt, and about 300,000 in shares in personal name set up by my financial advisor. Brett's strategy over the next 10 years is to invest $2,000 a month in a family trust. And the longer term strategy is at 45, reading between the lines, at 45 sell one of the properties and all the shares in the trust to repay debt, and then keep the 4 properties and the shares in his personal name, the 300,000 shares in his personal name. Hopefully, in 10 years' time, they're going to be worth a little bit more. That'll be the income producing assets. And would love to hear what Brett would like is this a good strategy and how would you invest? Like, how would you build the portfolio? So, Brett, you would have heard Campbell's episode last week, which is around land tax and the insidious nature of land tax, which I thought was a really good, insightful episode. And really, the conclusion is that rising expenses, including land tax or particularly land tax, means that the yield that you'll get from your property portfolio will be compressed over time. It's not an income asset. And so from Campbell's episode, the outcomes are, firstly, you need other assets. Property is good because it's giving a lot of capital growth. So it deals with the longevity risk, which means, you still got this compounding asset going in the background so that you're never going to run out of money, hopefully, but it's not income. So you need other styles of assets, shares, bonds, whatever. They're going to give you more predictable levels of income. And the other takeaway I got from Campbell's episode was that if we know that land tax is going to increase, and if we know that we're not going to really get much net income after all expenses from property, then we really need the capital growth. So again, it returns back to asset selection being one of the key aspects. So if I relate that to your situation, Brett, you're saying you're going to have a pool of shares, who knows, maybe 600, 700,000 of shares in personal name, and then 4 investment properties. That could work because what you could do, for instance, is use the shares, the income from the shares, and then you sell one property at 45 to pay down debt. You've got 4 properties left. Maybe in 5 years you sell another property, for instance, that will give you a lot more liquidity, and then you can put some money into the share market. So I think in your strategy, I think you will need to sell another asset, probably, depending on what your share portfolio does. I don't know if I would sell the shares in the family trust, because what Brett's saying is he wants to invest $2,000 a month for the next 10 years, accumulate a large portfolio, then sell it and pay down debt. The way I would consider it, and I'm not saying I would do this, but the one thing I'd be thinking about is looking at the share portfolio in the family trust as a cash flow machine that could help you service debt in the future. So selling the assets and then paying down debt, that's a good strategy in terms of reducing your outgoings, because you're going to get rid of that interest cost, of course, but it's pretty aggressive and that's pretty conservative. Whereas if you got to 45 and you had, let's say, $1 million in the share portfolio, portfolio in the family trust. And then that was going to generate $40,000, $50,000 of income. Well, potentially you can say, well, that $50,000 will service the debt and therefore I don't have to sell a property. So I know it's a bit contradictory because on one hand, I'm saying you might have to sell more property than just one. On the other hand, I'm sort of saying maybe don't sell any, but I think I'd just be thinking about those things. Look, who knows how all these things play out and over the next 10 years, how your properties will perform and what the income profile looks like and all those sorts of things. I think what I would say is it seems like a pretty good strategy to me, and there's probably nothing I would do differently. And how it is exactly going to work out, none of us really know at this point, but at least you've given yourself options. And, I agree that putting the shares in the family trust is a good idea. It gives you tax flexibility in the long run as well. And you might decide, for instance, to sell down the share portfolio in the family trust, not in one hit, but maybe over several years just to spread that capital gains tax liability, which is one of the benefits of a share portfolio, of course. We can sell incrementally over time rather than with property, we've got to sell it in one big hit. Okay, the next bit was how would I build a portfolio? Look, how would I build a portfolio? Well, personally, and professionally, I would invest in markets that exhibit the best opportunities for returns at the time that I'm making those investments. So to my mind, and this is how we invest when we do regular investing with clients, this is exactly how we approach it. To my mind, there's a lot of different options, right, in the market. So I want to choose the option that I think is going to provide the best returns over the next 5 to 10 years. So I'm looking sort of medium to long-term returns from a share market perspective. And when I look at the market, I go, well, emerging markets are cheap. Europe is priced more attractively than the US market, although there's a huge concentration in the top 10 companies in the US now, so it's not fair to say the overall US is bad. Value is the cheapest it's been for many decades compared to growth. What else would I say? I would say that because of the large cap dominance, mid and small cap investments look attractive as well. So I wouldn't necessarily want to go and I'm going to build a perfectly diversified portfolio in that I'm going to go buy, some of the ETFs that Brett mentioned was DHHF, which is a diversified fund, IVV, which is S&P 500. I wouldn't do that. NASDAQ, NDQ, I wouldn't do that either. You look at the returns over the last 10 years, there's not much left on the table in terms of future returns, I don't think. He mentions VEU, which is good. It's a ex-US ETF and that includes some emerging markets, so that's bang on that theme. But that's how I would build a portfolio. But I've got the experience to do that. I've got the knowledge and experience to do that. And, the approach that I talk about in the podcast, which is really just focus on those fundamentals that allow you to make those medium to long-term decisions. So I'm not trying to pick what the market will do in the next 3 or 4 months or even next 2 or 3 years. I'm trying to pick what the market will do or mean reversion will do over a 5 to 10 year period. And that's how I would build the portfolio, because to my mind, I'm then investing in sectors of the market that exhibit low risk. There's nothing more risky than investing in the NASDAQ, for example, after it's returned almost 20% compounding over the last 10 years. 20%. I mean, that just scares me. And I'd rather stick pins in my eyes than invest in an asset that had done that. I'd rather choose an asset that does have a good long-term track record, but has had a pretty poor 10 years, because to me, that just feels like there's a whole lot of upside. And that's how I build the portfolio. Now, if you didn't have experience to do that, well, then you're going to have to use more diversified ETFs. So DHHF, GHHF to put in some gearing in there. I think that's how I'd do it if I didn't have that experience. But good luck with it all, Brett. I mean, you're off to the races already, 35 years old, and you've already accumulated a lot of wealth on, as you said, a relatively low income. So, hats off to you. Sounds like you're on the right track, and I hope it all works out for you. Okay, next question is from a listener that wants to remain anonymous, which is fine, of course. It's a really long email. Okay, the couple, they're in their early 40s, couple of kids, 12 and 9 years old. Good incomes, 190 and 120. So, family income, what's that, 310? They've got 2 investment properties and a primary residence. Total worth of the properties, 2.6 with 1.3 mil of loans, all in South Australia in Adelaide. Superannuation, one is in defined benefit, public service defined benefit. They'll get an index pension around $150,000 a year, which is pretty nice. And the other one is in super fund, 400,000. Then they've got 140,000 of shares and 40 grand of cash as a sort of emergency fund. So in a really strong position. They will want to upgrade the family home in the future, and they're thinking about selling one of the Adelaide investment properties in order to do that, to also kind of reallocate investment monies too. So they're thinking money, we'll sell that, which will free up a bit of borrowing capacity for the home upgrade, and then we can put those monies in ETFs. And the long-term strategy is then to retire down the coast somewhere at age 55, so it's about sort of 10-ish years, and, have most of the property wealth in the family home and, live off the ETFs in personal names and super. Obviously they've got the index pension, 150,000, then there'll be projected another $2 million of super in the other spouse's name, and then a pool of assets outside. And what this list is asking is a good strategy. Any sort of ideas here? And, what do you spend for super or the ETFs? So the strategy seems fine. And, I'm not against selling one of the Adelaide properties. If you have a look at the sort of long-term trends. So I recorded that episode on the 20th of August, it was, long-term property data. And when you have a look at long-term trends, you go, well, Adelaide's most likely in for a bit of a flat cycle over the next period of time. So, taking some money off the table and reallocating those investments somewhere else doesn't seem like a bad idea. So I like that. I like the fact that you're really using your home to build wealth as well. So this listener, the investment properties they had were previous homes. So, they upgrade, keep it, as long as the asset selection's right, then it seems fine. So I don't have a lot to add, unfortunately. I mean, I think you're on the right track. There's nothing there that really concerns me. In terms of what to spend first, well, if you have a little bit of wealth in your personal name, it's actually quite tax effective. Like if you're in a situation where all you've got is, say, ETFs and super, obviously the super pension isn't going to be taxable, but the index pension will be, although you get a tax offset. So there'll be a bit of taxable income for the person that has the defined benefit income index pension, I should say. But the other person's not really going to have much in the way of taxable income. So it's actually kind of efficient to have some assets in their name because they're not going to pay any tax, because you can earn $20,000 a year in terms of income off investments and really not pay any tax. So it just depends on how the investments are owned and the individual tax positions. But if I had some clients and they were paying tax in retirement, well, then I'd try and eat away at the investments in their personal name first because they're least tax efficient compared to super. But I don't necessarily need to eat away at those investments to zero, I guess is what I'm saying. If I still have $300,000 in one person's name, they're not going to pay much tax, and it's going to be probably, just as tax effective almost as super, except for maybe the capital gains, although you can tend to manipulate them over time just by selling strategically and doing those sorts of things. So that's how I would look at it. It's a bit difficult to say today what you would do, but because it's going to depend on the tax position in the future, but that's kind of how I would look at it. So sorry to this listener that I wasn't able to add a lot of value there, but really thanks so much for writing in. Okay, next question is from Doba. Doba thanks me for the podcast. Moving to Australia, and so the podcast Doba saying has given him, a good understanding of the, financial and property landscape in Australia. So something I never really thought about, but I'm sure that would be handy for people that are moving to Australia. So you're very much welcome for that. Anyway, Doba is 30 and spouse is 29. The spouse owns a property on the outskirts of Brisbane. That's where they're moving to. It's worth $900,000 with a $570,000 loan, and they plan to move into that property when they arrive in Australia. But what they'd like to do is buy their forever home in 4 to 5 years' time, and that would cost around $1.5 million in today's dollars, like in terms of where they would like to live. But they realise that in 4 to 5 years' time, it could be 1.7 to 2, or maybe even more than that. Doba has about $400,000 in cash after liquidating investments overseas. He's bringing to Australia with him, and he wants to know what to do with the 400. He said that he works in IT and, could take a little bit of time to find a job, but, targeting sort of earnings of 120,000 or more. And the spouse is a nurse, expects to earn about 100,000 a year. And also acknowledging that buying the upgraded home as soon as possible makes a lot of sense. They put a time frame of 4 to 5 years just because that's what they think they need to get settled in their careers, get settled in terms of income position as well, and then have have enough borrowing capacity to go and buy. I think you're right. You want to hit the button on that as soon as you possibly can, even if you rent it out. So even if you live in the property in the outskirts of Brisbane and then go and buy your forever home and then treat that forever home as an investment property so you get the negative gearing on it, at least you're into the area that you want to get into. And I've spoken before about Brisbane. I think there's still some steam left in that market and still really positive sentiment around the Olympics. We're probably not going to see necessarily double-digit growth over the next few years, but I think till 2032 the growth could be strong. So the timing of the purchase worries me a little bit. 4 to 5 years, if you wait 5 years, you could be buying just at the end of a growth cycle, which is not ideal. I mean, it's your home, so it's not the worst thing, but that's something to think about. Whereas you buy now, at least you're going to build a bit of equity in the property. It's going to make you feel a little bit better, I think, in the long run. When there's uncertainty, and there's a lot of uncertainty here in terms of moving to Australia, making sure it's something that's going to work for you, that you're happy with, and then, finding a good job, and a good employer that you like and you can see yourself there, you're doing enjoyable work, they're enjoyable to work for, etc. There's a lot of moving parts here. So when there's a lot of moving parts, my preference is not to make any investment decisions because, for example, putting some money into ETFs or super, which is a couple of the options that Doba's suggested, they're long-term commitments, really. They're not just something you can do sort of willy-nilly. And so I don't want to make a long-term commitment unless I've got more clarity on what my longer-term strategy is. And therefore, then I can measure whether that's congruent to that long-term strategy or not. And so I think I just put the money in the offset account, which is kind of where Doba was leading anyway, but I think that's where I would go just because of the uncertainty. I wouldn't put it into super, not at your age. 30, you're too young to tie that money up in super. Even though it's tax effective, you're just going to need it outside family home, debt management, all those different sorts of things. As I said, I wouldn't put it into ETFs or other investments because, I just don't have the time horizon and you might, your strategy might change longer term. So I would just focus on, really bedding down your job, your employment situation, and then just making sure that, you're quite comfortable with the change in terms of moving to Australia. And when you're in a position where you feel like, yep, I'm happy and, I'm working for this employer and doing this particular job and I can see some longevity to it and I can see myself, being there for the next few years and this is what my income's going to do, et cetera, et cetera. That's when you'd want to try and hit the button on the purchase. And as I said, maybe buying as an investment first rather than initially as a home, but, it's going to depend on borrowing capacity and you might actually have to sell the existing property. But I would just really do everything possible, try and get into that market as soon as possible, but without overly rushing. You want to make sure you make a deliberate decision. So put the money in the offset. Sure, interest rates are falling, but it's still a pretty good return that's going to be risk-free. And regardless, I don't think you're in a position to make any other long-term commitments at the moment. Good luck with the move to Australia. Okay, next question is from Marco. Marco writes, absolutely love your podcast. Thanks so much for creating such a high-quality podcast. I own a mortgage broking business, and when it comes to money and financial matters, I mainly listen to you for my personal and professional development. Read all your books, of course. I really like how objective your approach is to topics, and you don't try and do any hard sell of services or anything like that. I really think I should be paying a subscription fee to listen to your podcast. I'll never charge for the podcast, but I appreciate the sentiment, Marco, and thank you so much. Mortgage broking is such a great career, I think. And, the funny thing is, when a person makes an inquiry in our business, we always ask about pre-existing relationships, your accountant, financial planner, mortgage broker, and we ask the person to kind of rank or rate that relationship out of 5. Obviously, 1 out of 5 means that they're very unhappy, and 5 out of 5 means they're happy. And it just got to give us a bit of background about, what pre-existing relationships they have. The thing is, the mortgage broker always gets the highest rating. I would say 90% of the time, maybe 95% of the time. I think that's really great because mortgage brokers are in a position where they can really help people. Like in terms of, I know when we work with clients on a mortgage broking side and they're going to buy a dud property, we would say, don't buy this, don't buy this. You got to think about these sorts of things. You got to do it this way. Or, someone approaches us and says, we're going to buy it in this ownership structure. We'll go, no, don't do that. Don't do that. So even though it's not advice per se, a good mortgage broker, and I've recorded a podcast on this, but a good mortgage broker can really add a lot of value to their clients. So well done, Marco. I think it's a really great career. Okay. Marco wants to know, he'd like to stop working in 5 years and he would like to know what he should do with some of his assets. And to give you a bit of a rundown, he's got a self-managed super fund with 1 residential property, 1 commercial property in it, and also some shares. shares. He's got 3 residential properties in a family trust, and he's got 4 residential properties in personal names. As well, in personal names, he's got shares, blue chip Australian shares and index funds. Now, just a quick addition, I calculate about 2.6 million of investment assets. I should have said Marco's 52 and his wife is 50 and she's PRYG. She's going to work to 57, so another 7 years. Marco would like to stop work in 3 years' time. Now, Marco can sell his mortgage broking business and he's got $1 million home loan. So that wasn't included in those net assets. So Marco's question is, if he stops working in 3 years' time, should he repay the home loan? Absolutely. I wouldn't feel comfortable personally retiring having non-tax deductible debt, particularly in your situation, Marco. I think you can sell the mortgage broking business and you should be able to use the small business CGT concessions to not pay any capital gains tax on that sale. You'll have to make a contribution into super to make that go away, but no big deal. And then you can use the remaining proceeds to repay most of the home loan, if not all of it, and maybe some investments or whatever. But I think, being able to sell the business and retire will kind of align with that. So it helps you get rid of the home loan. So that's certainly what I would do. And I'd certainly want to have zero non-tax deductible debt in retirement. He asked, would I be better off downsizing? But he's mentioned that he really loves where they live. It's a large block of land that keeps them very busy and active with gardening and maintenance and so forth. I don't think I'd downsize. I think you've got the business there, the business value, you can sell tax effectively, no CGT, repay the home loan. I think there's an answer there that's really good. You're going to have to sell the business anyway when you retire, so you've got to do something with that money. I wouldn't downsize at this stage, and you're only 52, so, you can always downsize in the future when you get sort of sick of the gardening and the maintenance. But, for now, I agree. I mean, if you really enjoy it and you love the area and it keeps you busy and active, I think I'd keep the home. And here's Marco's $1 million question. If we sell the business, repay the home, will we have enough assets to fund the rest of our retirement? And he wants $160,000 a year to live comfortably. Look, in 3 years, as I said, you've got 2.6 million from a rough calc now. And in 3 years' time, which is really when Marco wants to retire, look, that might be 3 million or so. That's probably enough I think it's probably enough to fund $160,000 in retirement, particularly since your wife's going to work to 57, so another 7 years. So you probably won't need to dip into the asset pool very much in, the first sort of 4 years of your retirement until she's fully retired. So really another 7 years, that asset pool of 2.6 might be worth, 3.1 or something? Sorry, 3.5, I was going to say. And that should be fine. The thing is, you probably need to move some of your deck chairs around. So because you've got some debt and against multiple properties, I would be selling, you're going to sell the ones that you feel less optimistic about future performance. And, the Victorian ones you probably keep a little bit longer just because obviously Victoria/Melbourne hasn't done so well. But the ones in the family trust is something you might want to start considering moving on, depending on if they attract land tax. I mean, the Victorian one would. He's got one Victorian property. There's 3 properties in the family trust, one in Queensland, one in New South Wales, and one in Victoria. It's quite possible that he's not paying land tax. Marco's not paying any land tax on the Queensland and New South Wales ones, but he'll be paying a little bit of land tax on the Victorian one. So that's just something you want to think about. Tax is only one of many considerations, so I think what you're going to have to do over the next 10 years is probably sell some of these properties to increase liquidity and try and get more of that wealth into super. But you've got plenty of time to do that over the next 10 years, gradually move it into super. And that'll help the liquidity inside the self-managed super fund as well when you start paying a pension, which is not going to be for another 8 years or so. So I think the asset value is okay, and there's a strategy here. It's just really about where it's invested and where it's owned. So personal names versus trust versus super. I think you need to make some changes, but otherwise you're on the right track. So good luck with it all, Marco, and thanks for writing in. Okay, next question is from John, and John's kind of in a unique situation where his super is in a untaxed fund. Untaxed super fund. His balance is 1.5 million, and his wife, and he has 500 in a Hostplus Choiceplus product, which is the Hostplus's similar to Members Direct in Australian super, which means that you can invest in ETFs directly, and it has the tax benefits associated with that. And his wife has some super as well, and also they've got a share portfolio about 2.1 outside super. So look, they're doing really well. And what John's question is, should he roll over his money from his public fund, untaxed public fund, into Hostplus in order to minimize fees and improve returns? So an untaxed fund, and there's not many around anymore. There's one in Western Australia I'm very familiar with, but an untaxed fund means that you don't pay your contributions tax when you first make a contribution into super. You only pay that contributions tax when you take the money out. And so it means that you get to invest that money pre-tax. You're really earning returns off the tax that you would have otherwise paid. Anyway, so it's a pretty good fund, and there's no contribution limit. So you can try and get as much in there as possible. And sure, you got to pay 15% tax when you leave the fund, but at least you're earning. That's an attractive option, but you're right. John's right, is you've got to think about everything, not only just the tax, but you've got to think about the returns and the fees, particularly with a balance like John's, which is, he said in the next couple of years, it'll get to close to 1.8 million. So he's paying a lot of fees because that fund charges 0.7%, where Hostplus is about 0.3 or just shy of 0.3%. So he's paying twice as much fees on a very high balance. And so these are the things we need to really carefully think about and consider. And it's, in July, I did a lot of episodes on super. And so I probably don't need to talk about that again. And John says he's confident that and feels comfortable with investing his own super balance. So he's done that for the portfolio outside and he's happy to do that inside. So that's a key thing, right? Because that's going to come back to investment performance. It's great if you can find a really low cost, transparent option, but if you completely mess up the investment strategy and the portfolio management, well, then of course you're not going to be better off. John, what I would do is just financially model it. So I'd look at and see, well, how would the balance change if I make some assumptions of staying where I'm at? So that is, I'm not going to pay the 15% tax. At least I get to defer that. I'm going to pay higher fees and I'm going to get lower returns. So where does that take me over the next 5 to 10 years versus taking the 15% tax hit now, going over to Hostplus, paying half the fees and hopefully getting a higher return? And I would just model it just in a very simple spreadsheet and work out, are you wildly better off? And what return, or is it just marginal? And what return do you need to justify to make it worthwhile changing? So if you did that calculation and you thought, well, as long as I earn more than 6.5%, for instance, then I'm better. Well, then you can make your own assessment of whether you think that's an achievable return. I would think it is, in which case then you should be right to move. The only other thing to think about when switching super funds is insurance, but John's 56 and partner's 55, so probably don't have any insurance or much in the way of insurance, so probably not a big issue for John. Actually, I should make a comment that I haven't looked more recently, but some of the government funds, the returns and fees are pretty ordinary. It's funny that the government can throw stones at other people in the super industry and criticize fund managers and these sorts of things, but they really should sort out their own backyard first. And, if you're working for the public service, you just want to make sure that your money's working hard for you and you're enjoying the returns that you should get. And, I think good on you, John, for looking at this a bit closer, because it's great to be in an untaxed fund and, sometimes people are blinded by the tax benefits, but, if the returns are poor and the fees are high, well, then there's no point saving that tax. Okay, thanks very much, everyone, for submitting your questions. Got through quite a few today. Tomorrow, I'm going to talk about property management. I haven't spoken about that before, but, for investors out there, I think there's some tips I can share in terms of how do you manage the property manager, what are realistic expectations, how do you pick tenants, those sorts of things. So hopefully that'll be interesting enough. And next week, for next Q&A episode, Campbell's going to jump in and do that one as well. So until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.